Gold has had a record-breaking run this year, and silver has surprised the investors with a significant leap. Let's get more and an outlook for 2026 from David McAlvany, Portfolio Manager and CEO, McAlvany Financial Companies. David, thanks very much indeed for joining us. We know why gold is up, or the reasons that were given, but what about silver? Why has silver taken off?
Well, silver is at the confluence of industrial demand picking up. At the same time, investors are paying attention on a global basis to inflation. We had a tremendous impact in the market from Indian demand this year. I think a part of that is as gold gets to higher levels, there's almost a substitutionary effect where people look at the affordability of silver, the accessibility of silver, and as a precious metal, it's a decent or reasonable substitute. So demand there has been phenomenal. We continue to see huge demand on the industrial side, particularly in solar. And that's something that was not a factor 5 years ago. In the 5-year period where industrial demand for silver has picked up considerably, we're also talking about being in or operating in a supply deficit through those 5 years. So I think we are at that sort of inflection point where the market's recognizing supply deficits. And with the increase in industrial demand, now just at the margins, you get investors to step in and you realize just how small the market is with an explosive move up 100% this year.
Silver for a long time languished relative to gold. What about the famous ratio between gold and silver? Is silver still relatively cheap by that measure?
Absolutely. It is very cheap relative to gold. In the context of a precious metals bull market, typically you'll see the ratio trade between 40 and 65. So the fact that most of this year we've been stuck around 80, 85 has put it in the value range for sure. Now today we're closer to 73 to 1, and it is beginning to break out. So normal patterns, normal behavior, but it does imply significantly higher prices just to get into a normal trading range. The gold-silver ratio is something that certainly suggests we could see in short order within the next 6 months, certainly within the next 12 months, a $65 to $80 price per ounce.
You say that bullion can be a good holding here. Would you do it with physical gold held securely, or would you be inclined to buy one of these ETFs that say we're backed by physical precious metals?
I think both are reasonable options. It just depends on what the motivation of the investor is. If it's for fun and profits and a fast trade, I think the ETF liquidity is superior. If you're looking at something that lacks any counterparty exposure, then I think that's where bullion physically held makes all the sense in the world. It doesn't appear that people care too much about counterparty risk today, although we have a growing bond bubble on a global basis. If you're looking at government bonds, not a lot of indications of stress in the bond market as of yet, unless you were to see gold as perhaps an indicator, a canary in the coal mine, so to say, for ultimately unsustainable fiscal positions, not just in the U.S., but in many of the G7.
That's interesting. You think government bonds, there is a cloud over them now?
Well, they don't trade like there's a cloud over them, but I do think the unsustainable nature of our expenditures, I can speak to the U.S. Certainly more clearly. You know, we've never spent $2 trillion a year in excess without there being a significant economic issue in play. We could look at the pandemic, we could look at significant recessions or being in wartime. Then and only then do we spend this kind of money. And so to do so without sort of emergency cause suggests that there is reasons to be concerned in the market. Currently, our interest on the national debt exceeds $1 trillion and is marching towards 20, even 25% of all tax revenue for 2026. So I would say that that's in the category of unsustainable.
One stock you've suggested to us in the past has been Pan American Silver, PAAS. Is that a name you still favor?
We do. It's difficult to look in the silver space for very high quality names, and I think it's actually easier in the gold space to find the best management and superior business models. Franco-Nevada and the royalty names are certainly the best in terms of a business model, but if you're looking for superior management, Agnico Eagle is still at the top of our list. Pan American makes the cut, but there are very few silver plays, pure play silver plays, that have great resources, great geographies, and great management, which is one of the reasons why we've leaned into Pan American.
What about Barrick? Have you been following that saga, the potential spin-off of their North American operations? Do you think that will improve sentiment when it comes to ABX?
Yeah, it is a portfolio holding. We've owned it as essentially a turnaround story where they needed to get past the conflict in Mali with the government there. They seem to have resolved most of that. I think the board is recognizing that there is a differentiation between geographies, and to be in Tier 1 does matter. And so to carve out their Tier 1 assets and separate them out from Tier 2, 3, and 4, I think we'll have significant uplift, particularly for the listed North American assets.
And finally, what would deter you from buying gold? What could go wrong here?
What would deter me from gold is it's expensive. You look at 4,200. We think that it can trade to $5,000-$6,000 next year. Longer term, even 8,000. The thing is, a move of 60%. It certainly gives investors pause to say, do I really want to step in near all-time highs? I would just remind people to look and count M2 money supply and the growth in money supply in recent years and recent decades. Realize that the value of the currency itself is far less. That's obscured somewhat when you look at the dollar index, where you're weighting strength against these other currencies, whether it's the yen or the euro. So what would give me pause is that it's expensive. Mm-hmm. What would probably release me from that resistance or constraint is that it's a very under-owned asset. If you look at institutional managers, if you look at retail investors, it represents a very small percentage of their portfolio, if anything at all. And so I think expensive, yes, but still very, very under-owned. I think the adoption cycle is just beginning. With Mike Wilson at Morgan Stanley, it suggests this significant model shift from a 60-40 portfolio, 60% equities, 40% bonds, to what he views as more appropriate in this environment. And it goes back to my comments on the bond market, where now he suggests 60-20, 20% bonds, 20% gold. Why would you substitute half of your bond portfolio with gold if there wasn't significant structural issues within the bond market? You have to be recognized, clearly. But watch the MOVE index, and I think you'll have an indication for when stress is emerging there. So we see a lot of folks moving into gold, maybe on a first mover basis, anticipating these unsustainable bond market conditions.
Thank you very much indeed for joining us, David. David McAlvany.